Welcome to part three. This is where I share my macro outlook. So we're going to start looking at some of the data from last week, especially in the US. So Friday's US ISM manufacturing remained in contraction. Now that's the 10th consecutive month that it's been below 50. Although you've got to say it did come in higher than it was in July at 47.6. So again, this is, I've got a bit of a problem with the surveys, and I'm still unconvinced that they deliver an accurate measure. And that's just due to the low level of responses that are given. Quite often it's only between 35 and 50% that actually reply to them. So, how accurate is that picture? Construction's improving in the US. Buyers are coming to terms with the fact that their mortgage rates are at 20-year highs. Now, does it make that much difference? Because many of them would have received a bump in their salary or moved company to get a higher wage, which would have compensated for that. I think the thing going forward now is that, as jobs available continue to shrink, and job losses potentially increase, especially in certain sectors, that I'm expecting more workers to stay put, to stay with their current employer, and the reason for that is it's going to, in their mind, give them more job security, if there is such a thing, over a higher salary. And of course, when it comes to getting rid of people, it could be sort of FIFO, well, last in, first out, so LIFO. But it's a situation now where I think you will start to see less people moving for a higher salary. Moving on, so sort of house prices in the US, they have begun to increase again. Now, is that demand? I think it's probably more just a lack of supply. Because the reason for that is going to be because there's many that are still locked into those cheap mortgages. They took them out when they bought their house around 2.5%, 3.5%. So they're reluctant to give that up and move and have to take out a new mortgage at potentially 2 or 3 times what their current rate is. And that's putting pressure on rents as well. So it's possible that they've sort of topped out for the moment, but they still remain expensive. The new build construction's higher. That came in at 1.4% in July. It was even higher in May and June though, so it was 3.5% and 1.5% respectively. Now, non-residential property, so the construction, that's been rising consistently for 14 months now. And of course, that's due to Biden's Inflation Reduction Act. So that's encouraging, that construction's area. And obviously they're being helped with that. So next week's services for the ISM is expected slightly lower. And we're going to see that because I think, as I said, I think it was last week or the week before, that manufacturing should be bottoming out now, and the services should have peaked. So it makes sense to see a little bit of a correction in both of them, and then start to maybe converge a bit more. It's not going to be a quick process though. Then US jobs last week showed there was only modest gains. And that sort of the unemployment rate jumped 0.3% to 3.8, which was I think probably a surprise for most. But to me, this all just fits in with sort of predictions I've been giving over the last months and that, especially around the jobs, because jobs available, which was over 10 million, is now down to 8.8 million. And the unemployment rate's rising, and it just makes sense that as these higher rates sort of bite into consumers and to companies, of course, that this is going to happen. At one stage, the jobs available versus those unemployed that could work reached 2.1. it's now back below 1.5, and I think it's probably likely to fall further. NFP came in slightly higher than consensus. Although, what you should sort of take from that also is the downward revisions over the past couple of months as well, which was around about 110,000. When it comes to sort of the areas that are employing, then health and private education are two that are still growing, along with leisure and hospitality. And of course, remember them over COVID, they were destroyed. But of course, as we was all released, we wanted all that. We'd missed all that. So it's understandable that they're still growing. Now, with inflation still sort of hurting households' income, there's more people trying to re-enter the jobs market anyway, to help to pay the bills. So of course, a lot of the men are working already, so that's the wives or partners looking to enter the workforce to help to pay those bills. This recent data, for me, is not necessarily just going to lead to a pause by the Fed, but it could mean now that US rates have peaked. Now, you've got to remember with that it doesn't mean that they're suddenly going to turn and change policy and drop rates. I can't see that happening before mid-24. But, just remember, that's only my view. But I'm sure Powell and co are pretty pleased at the moment with themselves, the way that the US economy is moving. So far, they have seen inflation dropping without a massive impact on jobs. Okay, a few losses, but not big. And a soft landing does remain very possible for them. Consumer demand is dropping, but that's again a combination of higher rates, but for me, more importantly, higher prices. It's forcing households to make those cuts, especially now all their savings from COVID have gone. That demand should take another knock from the restart, obviously, of these student loans. That's a big number. That stands around about $1.5 trillion. Now, it's quite interesting because some employers are actually using that to attract workers by offering to make those payments on their behalf. So if they join the company, the employer will make those repayments monthly for them. And of course, it's an incentive for them to stay with the company if and when they do that. Now, when we're still looking at prices and all that, and market prices, even the Russia-Ukraine war and the bombing of ports and ships, it's had little impact on grain prices. There was an initial spike, but they've dropped right back again. Now, where I do see an inflation problem is oil prices. They've rallied all week, and they did touch $86 for WTI on Friday. And that came about after Russia claimed that they'd convinced OPEC Plus to make further supply cuts and for the Saudis to continue with their voluntary cuts. And of course, the Saudis have been increasing oil prices as well. Now, this will of course impact petrol, gasoline prices at the pump. Fortunately in the US, it's just as the summer driving season comes to an end. Now, if we take a look at Europe, it's a very different situation, unfortunately. These higher oil prices, it could just give another bump to inflation. We haven't had as much success bringing inflation under control. Yes, it's coming down off its peak, but it's still much higher than it should be. And I can see that bump probably happening around October, November. And plus, I'm in the UK, so plus it feels to me as though the temperatures are already starting to drop. And I get a sense that this winter could be much colder than last year's very mild winter. And of course, that's going to increase demand for gas and electricity. And that could cause problems for Europe and indeed households as these energy bills spike again. and that's going to lift inflation and possibly could be the final now in pushing Europe into recession. Now, it is possible. Whether they would be willing to do it or not, I don't know, but it may need for the governments to subsidise domestic and possibly industrial energy costs over winter if they want to avoid that recession. At the moment, they do have high enough levels of reserves, gas reserves especially, but will that be enough to see them over the whole winter or not? As I mentioned, inflation's been falling slower in Europe, and this is being felt everywhere in Europe. Europe's largest economy is really suffering more than its peers. It's not often you get to say that, and considering they are considered the weak link, which is really strange. But there's been a lack of investment in Germany. They've got weak manufacturing, apart from the manufacturing part, the demand for goods as well. And part of that's been caused by a weak Chinese economy. It's failed to create that boost to German exports that they were probably hoping for. The ECB may still need to hike at least once more, as to with the Bank of England. And of course, we're in September now, so we're going to start to see all these central banks making these decisions now that the summer recess is over. In China, it's trying to boost its economy. It's doing a variety of economic measures to try and make that happen. However, I just don't think that they've got the same growth potential. And after that subprime crisis, local governments now, I think after the subprime, it was just when they really started to grow. So they didn't have all this debt. They didn't have all this, they hadn't taken on any sort of the Western blueprint as such. I'm not saying that they've followed it completely, but certain parts of it, I would say, that have embraced more. But they've still got their problems. They've got real estate and of course high local government debt, and they're really holding the economy back. And that's impacting because that's creating lower consumer demand. And of course, just in general, because there's many countries that their natural demand is lower because the prices are so high and they just don't have the disposable income. But also, local goods and services, those supply chain issues, most of them have been sort of recovered from. Now, the problem I think there as well is the fact that a lot of the countries have decided that they can't take that risk in the future, so they've brought a lot of those industries in-house. They're bringing them as close to home as possible. Now, another point around China is they're antagonizing a lot of their sort of neighbors. And the reason they're doing that is they brought out this controversial map claiming ownership of many disputed territories. And that's leaving them a little bit isolated, and it is damaging their exports because a lot of those countries are sourcing their imports from elsewhere. So although inflation overall is moving in the right direction, if you look at prices 2 years ago compared to where they are today, for me, I just think that they're sort of 20 to 50% higher for some goods, especially food, which just seems crazy. Now, as I said earlier, I do believe rates are getting very close to the peak, if not at the peak. But it's going to take time, and that current series of those rate hikes that we've seen to really feed into the economies because of that lagging impact. it can take up to a year for some of these rate hikes to feed in. So, where we are now, even if they stop putting their rates up, doesn't mean that's where the economy is going to finish, because that lag impact is still going to come in. So you can still see a drain on the economy even after they stop hiking. So, just be prepared for that. And of course, we may discover that central banks have indeed overreacted in their quest to beat this inflation. And, that could lead to the times where all of a sudden the potential for that recession increases. It's strange because for me, we want everything today. So I think that's almost the same for the governments and the central banks. It's gone at the times where the economy would go through these big long cycles. They've boosted and speeded up those cycles, especially when it comes to sort of trying to stop any sort of economy going into free fall. It seems that they're too impatient, and they jump in with this stimulus as soon as an economy starts to weaken, to kickstart it again. QE, I'm not a fan, I must admit. I think it's the easy solution. I really don't believe it's the best. Another area we've got to start to look at is credit, because that may well become sort of the next issue. And that's going to be around government debt, which is at record levels, but also personal debt, because that's likely to continue to increase as households have used up all their savings, and they're living month to month on their paychecks, but that may not even be enough for them. And that's going to be more difficult as well, because especially in the US, because the banks are tightening their lending as well. So markets are probably holding up better for now than expected. It amazes me sort of when we look at the US data that the dollar's been under so much pressure in recent months. That's really been a surprise for me, and I'm a big fan of the dollar, because I focus very much on the US economy, and it's the best. It is really. I suppose some of the oil producing countries, forget Russia of course in that, they've got a very strong economy as well, but when you just look at the more sort of Western economies, then I would say in the developed world the US has definitely got the strongest, and I can't see that really changing. I think investors and traders need to focus more on the bigger economic picture again now, rather than just interest rates, which is what they seem to have been doing. And of course unemployment, because I can see that still creeping up. Okay, so that's my macro outlook. So again, just a reminder of our services. I'm not going to bore you by going through them, but trust me, we offer great stuff. Check us out on our website. That's the best thing to do. If you've got any questions about everything that we offer, then just contact us either at info@symaxfintech.com, or you can send directly to me at chris.tubby@symax-int.com. Okay, so part 4 is where I do my chart analysis.